Imagine a world where you can own a fraction of a Manhattan skyscraper, a barrel of fine whiskey maturing in Ireland, or a U.S. Treasury bond with nothing more than a digital wallet and a few $100s. That world is no longer theoretical. It is being built right now through the tokenization of real-world assets. Today we're examining why some of the largest institutions on the planet, including BlackRock, are calling this technology the most important financial innovation since double-entry bookkeeping. Tokenization is the process of recording ownership rights to any real-world asset on a blockchain as a digital token. These tokens can represent full ownership, fractional ownership, or simply exposure to the asset's performance. The implications are enormous: instantaneous settlement, dramatically lower costs, and access to investment opportunities that were previously reserved for institutions and ultra-high net worth individuals. BlackRock CEO Larry Fink and COO Rob Goldstein recently wrote that ledgers haven't been this exciting since the invention of double-entry bookkeeping. They compare today's stage of tokenization to the internet in 1996, early, underappreciated, and on the verge of explosive growth. The numbers support that view. The tokenized real-world asset market stands at roughly $35 billion today. Standard Chartered forecasts it could reach a cumulative $2 trillion by 2028. Meanwhile, BlackRock's own tokenized money market fund, BUIDL, has already surpassed $2 billion in assets under management on public blockchain infrastructure. Real examples are already live. 1. Fractional shares of the St. Regis Aspen Resort are traded as Aspen coins. 2. Investors can own maturing Irish whiskey casks via tokenized certificates. 3. Tokens like Pax Gold let anyone hold allocated physical gold in LBMA-accredited vaults. 4. TBILL tokens from Open Eden track short-term U.S. Treasuries with accrued interest paid on-chain. Why is institutional adoption accelerating now? First, stablecoin liquidity has crossed $300 billion, providing the on-chain dollars needed for large-scale trading. Second, regulatory clarity, such as Europe's MiCA framework, is reducing uncertainty. Third, the U.S. Federal Reserve ended quantitative tightening on December 1, 2025, signaling easier global liquidity ahead. Yet significant challenges remain. Legal recognition of tokenized ownership varies by jurisdiction, tax treatment is complex, and counterparty risk standards must be preserved. As Fink and Goldstein emphasized, a bond is still a bond, even if it lives on a blockchain. The bottom line is clear. Tokenization is rapidly becoming the first crypto narrative capable of attracting sustained institutional capital at scale. It has the potential to integrate blockchain technology into the core of global finance rather than remaining a parallel speculative ecosystem. In your opinion, which real-world asset class is poised to experience the most rapid tokenization in the years ahead? Share your view in the comments. If you found this analysis useful, please hit the like button and consider subscribing for weekly updates on institutional crypto and macro trends. Thank you for watching, and I'll see you in the next one.